investment banking. Your student is joining. Okay, we should have to start. Loan review. Meaning, loan review is systematic process of evaluating the quality, performance, and risk of a bank's loan portfolio to ensure early detection of problem loans. Okay, loan review is a cornerstone of credit risk management and financial portfolio oversight. It serves as a quality control mechanism that assesses loan performance, regulatory compliance, and emerging risk exposures after loan origination. The process is critical for banks, credit unions, and lending institutions to ensure portfolio health, minimum losses, and maintain regulatory compliance. Objective of loan review: evaluate credit quality, assess the creditworthiness of existing loans and the accuracy of risk ratings. Second, ensure regulatory compliance. It confirms adherence to laws, internal policies, and agency guidelines. Third, detect early signs of stress. It identifies problem loans or sectors showing early risk signals. Fourth, strengthen credit risk management. It helps refine underwriting processes and improve loan portfolio oversight. Fifth, support management and board decisions. It provides actionable insights to optimize lending strategy and portfolio allocations. Six, reduces repurchase or financial risk. It particularly for secondary market lenders, ensuring compliance to avoid buyback demand. Who conduct loan review? Loan review can be conducted by various parties depending on the institution structure. Internal independent departments. Banks often maintain independent loan review teams reporting to senior management or the board, and external auditors or consultant. Third party firms provide objective assessment, particularly useful for institutions lacking experienced internal staff. Why institutions or bank appoint external audit? Because institutional lacking experience of internal staff. Secondary market investors, entities like Fannie Mae, Freddie Mac, or private investor performance post-purchase audits. Types of loan reviews. Loan reviews falls into two primary categories: compliance reviews and safety and soundness reviews. First, compliance reviews focus on regulatory adherence and consumer protection compliance. Second, safety and soundness reviews examine credit quality, portfolio risk rating, and the institution's financial stability. Loan review process. A robust loan review typically involves these structured steps. A. Planning and scoping. Selection of loan based on the risk portfolio size or exposure. Define scope, documentation, policy adherence, risk rating accuracy. B. file examinations, verification of borrower information, income analysis, collateral and legal documentations, assessment of underwriting decisions, and credit policy adherence. Out of you, few students or their parents may have taken loan from banks or commercial institutions, financial institutions, and they may have know about the process of what kinds of documents that you have to provide at the time of sanction loan. Okay, I have also explained you about 7 by 12 extraction, Satbara Utara, and all your Aadhaar card, PAN card, your CBIL, okay, your property documents, and your checks. These are the basic components required at the time of loan review. C. Risk evaluation and analysis. Classification of loans into standard risk categories: pass, special mention, substandard, doubtful, and loss identification of trends across portfolio segments and emerging risk. D. Reporting and communications. Preparation of loan review reports, LRR, includes executive summary, methodology, specifications, finding, and recommendations. When you will start your research project, you have to give executive summary, discussion with management and credit teams for corrective actions and timelines, reporting to boards of relevant committees to ensure transparency and oversight. E. Follow and corrective actions, monitoring implementation of recommendations, updating loan risk rating and provisions, including allowance for loan and lease losses, ALLL, that is allowance for loan and lease losses. Nowadays, banks also hired few agents to generate loan proposals. They have offered 1 to 2% on total loan. Means it's a best business, and so many people got this business and generating much more income. 5. Common finding on loan reviews: income miscalculations, error in variable or self-employment income, missing documentation, incomplete verification, insurance or legal paperwork. Yes, banks also take insurance while you are taking loan from any institutions. Why? Because if a person who is taking loan after his death due to any occurrences or accidents, what will happen? The insurance company will pay the amount of the sum assured person. Means you have taken loan of 10 lakh and bank drawn insurance of 20 lakhs. What will happen? If you have paid few amount, that is principal amount with interest, and you have to pay principal amount only 7 lakhs. Okay. After the date of that person, what will happen? Bank will give the remaining amount from the insurance to the nominee of that loan holder. Means suppose bank has to take 7 lakh as a principal amount and 50,000 as an interest. Means bank will withdraw only 7 lakh 50,000 from the passed claim amount, that is of 20 lakhs, and remaining 12 lakh 50,000 amount will be paid to the nominee of that loan holder. Unsupported policy exceptions, unauthorized or undocumented deviations, compliance failures, violating secondary market or regulatory standards, inconsistent underwriting, uneven application of credit policies or risk assessment, data discrepancies, mismatches between systems or record. If the data is not fed by the operator properly and the senior authority found mismatch between the existing physical documents and the data in computer or software, then he will inquire about which is the perfect data. So when you will be at the desk of a loan and you have the responsibility to feed the data, you should have to feed all the documents carefully and all the records data carefully. For example, name, mobile number, email ID, nominee, Aadhaar card number, uh, PAN card number. If he has or she has passport, then passport number and all the check numbers and the name of that bank which check that he or she has provided. 6. Frequency and scope of reviews. Reviews are periodic, annual, quarterly based on loan type and risk grade. Risk based on event driven. Reviews target higher risk loan or segments showing performance changes. Random sampling may complement risk based coverage to ensure comprehensive oversight. Random sampling means it is taken from our research also. Means the loan review committee also has to take all the research. 7. Organizational considerations. Independent loan reviews team must operate separately from loan origination to maintain objectivity. Qualification. Staff should have relevant financial credit and regulatory expertise. If you are already a MBA student, then you have the potential or competency about to verify loan proposals because we have the practical knowledge as well as theoretical knowledge learned from the college or books. Reporting structure. Typically, the loan review functions reports to senior management or directly to the board. Means at the time of finalization of every loan proposal, it will be finalized by the authority, senior authority, but it is categorized with the amount. If small loans cases are there, then branch manager also have right to finalize that loans. Means below 5 lakhs cases, bank manager or branch manager have the authority to finalize it within few days. Okay, but above 5 lakhs to 20 lakhs, branch manager must have to take permission of general manager. Okay, and the loans about 20 lakhs, all the authority given to the director board. Director board will decide whether to pass this loan, sanction this loan or not. Means loan for big projects or more than 1 crore projects. Benefits of an effective loan review: enhances portfolio quality by detecting emerging risks, provides early warning for potential non-performing loans, improves underwriting standards and operational practices, supports regulatory compliance and reduces legal or reputational risk, strengthens confidence for stakeholders, including investors, auditors, and regulators. 9. Tools and technology. Modern loan review process increasingly leverage automated systems and platform to standardize income analysis and documentations, reduce inconsistencies and humor error, streamline report generation and portfolio monitoring, enable proactive rather than reactive risk management. Mostly, it has been tried to avoid human errors. Loan review is an integral retrospective oversight function within credit risk management by combining objective evaluation, risk-based selections, and actionable reporting. Financial institutions can maintain robust loan portfolios, ensure compliance, minimize losses, and proactively manage credit risk effectively. Loan reviews is both a safeguard for institutional health and strategic tool for portfolio optimization. Process of loan review: already seen that periodic inspection of loan accounts, review of borrowers' financial positions, verification of collateral and documentations, risk rating, reassessment, reporting to senior management. Benefits: prevent loan slippages into NPAs, means converting the loan into NPA, strengthens credit discipline, enhances portfolio quality, supports regulatory compliance. Now, NPA, non-performing assets management, meaning an asset become NPA when interest or principal remains overdue for more than 90 days. This is the basic rules. Non-performing assets, NPAs represent loans or advances where borrowers fail to meet scheduled principal or interest payments for a specified period, usually 90 days or more, according to the Reserve Bank of India, RBI guidelines. NPAs are critical indicators of credit risk in banks, impacting profitability, liquidity, and overall financial stability. And bank has guidance to provide NPA list every month. If every bank get delay, they have to be punished from RBI, and punishment amount may be in lakhs, that is 50 lakhs and more. Than classification of NPAs based on the extent and duration of defaults. Substandard assets, NPA overdue for less than or equal to 12 months may yield partial recovery, require moderate provisioning. Doubtful assets remains in substandard category for more than 12 months. High risk of recovery, higher provisioning required. Doubtful assets and doubtful debt, the provision may be from profit which is incurred at the financial completion of the financial year, that is after 31st March of every year. Means uh, every bank has to do provision that NP amount will be deducted from profit, and other provisions also done by the bank for future expenses. Loan assets identified as uncollectible by bank auditors, RBI inspections requiring full write-off or provisioning. Special mention accounts, SMAs act as early warning indicators before classification as NPAs, SMAs, and overdue days. Okay, means special mention accounts. SMA 0, its overdue days from 1 to 30. SMA 1, overdue days from 31st to 60 days. SMA 2, overdue days 61 to 90. Causes of NPAs, internal factors, poor credit appraisal and loan monitoring, diversion of loan funds for non-approved purposes, inadequate documentation, and risk assessments. Few times what's happen, someone what say that just pass the loan, I am already know you and you also acquainted acquaintance with me. So please let me to sanction this loan and I will provide you the documents after few times. And what happened? The manager believed or trusted on his speech, but he do not submit the documents within the time span and a loan is already disbursed. What will happen? The whole responsibility will be on the manager. Weak management oversight and absence of early follow up. External factors, willful defaults by borrowers despite capability to repay. Sector specific external shocks, that is fuel price rise in aviation, mining bans, macroeconomic slowdowns or crisis. For example, the 2008 financial crisis and COVID-19 impact. In COVID-19, so many people was unable to repay the loan installments. Also, government suggested banks that keep patience, do not torture to the clients or consumers of loans about recovery because maximum people has stopped their income sources. Policy and regulatory delays affecting business cash flows. Impact of NPAs, bank profitability, higher provisioning reduces net income. Second, capital adequacy increases risk-weighted assets, requiring banks to maintain higher regulatory capital under Basel III norms. Third, credit contractions. Limited lending leads to reduced economic growth. Fourth, investor confidence. High NPS erode shareholders' value. And fifth, public confidence. Systematic credibility undermined due to stressed assets. Now we'll see NPA management approaches. A. Preventive measures, risk mitigations, credit risk management CRM. There is another CRM in MBA, that is customer relationship management, and this is credit risk management. Early identification using thorough credit appraisal, borrower background checks, and sectoral risk analysis, MIS and sensitivity analysis, monitoring early warning indicators, and correlating against macroeconomic variables, regulatory capital management, aligning with Basel III standards to absorb credit shocks. B. Recovery and resolution measures, debt recovery tribunals, DRT, means faster legal redressal of loan recovery, just like consumer courts. Consumer courts, why there are consumer courts? To give the judgment to the customer who have brought a product from any shops or any supermarket, but there is a fault in that product or there is a damage in that product, and he found that he got cheated from the shop or super shop, then he can file a complaint to consumer court. In that way, for a loan, debt recovery tribunal is there or faster legal redressal of loan recovery. Credit Information Bureau, sharing information on defaulters to prevent morally hazardous lending. Yes, why? Means this creditor should not have to take loan from the other institutions if he has declared as a defaulter by any one of the financial institutions or banking institutions. There is a chain of all the banks. Nowadays, banking regulations and new developments are there to do online transactions also, because so many people are get cheated from the outsiders or cyber threats. So what the new rules taken by the government, that every URL, means uniform resource locator, or website name, www World Wide Web, or it's also called as domain name, it will be start with the name of bank. Means if you want to search bank's website, you it will be helpful to you that it's not the fake website, because so many people create the same website with logos and the color combinations of the bank, and many people are confused or confusing that is this the right website, and trying to give information about their user ID and password. What will happen if you will give user ID and password? Your password will be automatically opened to that frauders. Okay, so government has taken decisions that every banking website will be start with bank name, bank.sbi.in, bank.yonosbibusiness.in, or nic.in. NIC means National Informatics Centers. It is a government organization which are providing all the IT websites and softwares. Asset reconstruction companies, ARCs, acquiring stressed assets for faster resolutions. SARFAI ESI means SARFA ESI Act 2002, legal powers for bank to seize and sell collateral without court interventions. Means once a person is became a defaulter, the bank or financial institutions may have the right to sell or seize the property of that defaulter person or loan holder person without intervention of court. Okay, he will not take any court orders to stop the seizing and sellout system. Insolvency and Bankruptcy Code IBC 2016 provides time-bound incorporate insolvency resolution, improved recovery rates, post implementations. Few investor people are always in this search that they are finding the properties which is already banded by the bank or it is seized by the bank, means that property will be sold by the bank in very less prices. What banks or financial institution wants, they want only their principal amount and interest. If more than that amount received from the buyer, it will be given to the defaulter person or loan holder person. But in this case, bank will not think that if this property is of 50 lakhs and the person has taken loan of 10% and he repaid uh, 3 lakhs, only 7 lakhs are remaining. But property which is seized by the banks or financial institutions and auctions is there. In auctions, that property sold up to of 20 lakhs rupees. What will be happen? The 30 lakhs benefit will be of that investor. The investor will sell that property in 50 lakh or in 1 lakh, maybe. So many investors are in search to find these types of properties, engage the properties. Corporate debt restructuring CDR and strategic debt restructuring SDR converts loans to equity or restructure repayment schedules under guidelines. Special schemes for SMEs and retail loans, tailored strategies for high risk sectors to contain future NPAs. C. Sectoral risk focus, data driven NPA ratio analysis per sector, that is corporate, SME, retail, and agriculture. Targeted early intervention for high risk sectors like SMEs and constructions. 5. Quantitative indicators for risk management, gross NPA ratio, GNPA. GNPA divided by total advances. Net NPA ratio, NNPA, equal to GNPA minus provisions. Provision coverage ratio, PCR, it indicates preparedness against potential bad loans. Case illustrations, SBI 2024 sector and their gross NPA. NPA shown of SBI of 2024 from different sector. First sector is SME and gross NPA is 8.2%. Corporate sector 7.1%. Agriculture sector 5.9% and retail 4.8%. Means near about 25 to 30% NPA, gross NPA is there in this financial year. Observation: SME sector exhibited highest NPAs, suggesting focused risk assessment is essential for these loans. Six, key principles of effective NPA management in this framework. Early detections: classify emerging stressed assets using SMA framework. What happen? Few people takes crores of loan from the banks or financial institutions, and what did they do? They went or goes to foreign countries. Okay, means they are totally bankrupted, just like Malya, Vijay Malya, and others. But in this case, government sees their all the properties if they ran away from our country to another country. Credit governance: strong internal policies with well-defined responsibilities, robust legal framework. SARFAI SI, DRT, IBC enables faster recovery and reduces litigation delays. Technological integration: core banking systems, CBS and MIS support real-time risk monitoring. Now we are lucky that if you are in any bank, you are using core banking system, and that is available in Windows environment. Before 2 decades, there were DOS environment, means disk operating system environments, means only command based softwares were there, means black and white environment were there to enter data in the software. That time, mainframe computer was there, P4 computer was there to enter all this data. But nowadays, you have a little mouse with two buttons and one roller to navigate ups and down, and it's processed very easily to jump from one location to another. But what happens in a DOS system, if you want to go from one location to another, you must have to go from the all the tabs positions set by the software. It's a key sequences. Okay, but in core bank solutions, you have the software of Windows environment. Nowadays, you have the core banking solutions that are cloud based also. Means before 1 decade, you are not unable to do transactions from multiple branches. Now you can do transactions in multiple branches of any bank, whether it is corporate bank, cooperative bank, or any district bank. Capital adequacy and provisioning: compliance with Basel III for resilience, strategic restructuring, reschedule overdue loan or convert to equity under SDR, CDR strategies, sector specific monitoring, assess microeconomic and industry specific risk proactively. 7. Post COVID lessons and modern practices. Moratoriums demonstrated the importance of dynamic NPA classification rules, emphasis on scenario testing and stress testing through financial simulations, reinforced the use of SPSS and other analytical tools to monitor NPA trends. SPSS is statistical package for social sciences. You have to use this SPSS software for ANOVA, analysis of variances or variables, priority for digital recovery channels, and automated credit risk alerts. NPA management is a core element of credit risk management in India. Effective management combines preventive policies, targeted recovery strategies, sector specific oversight, regulatory compliance, and technology integration. Continuous monitoring, early intervention, and structured frameworks like the IPC, combined with Basel aligned capital adequacy norms, strengthens banks' resilience, improve profitability, and maintain economics stability. Cause of NPS: poor credit appraisals, economic slowdowns, willful defaults, project delays, ineffective monitoring. NPA management techniques: preventive measures, proper credit appraisal, early warning signals, regular monitoring, risk-based pricing. Corrective measures: restructuring and rescheduling, recovery through SAR, FA, ESI Act, Lok Adalat, and DRT. Assets reconstruction companies, ARCs, one-time settlement, OTS. Importance: improves profitability, enhance liquidity, protects bank capital, strengthens financial stability. Next is Basel Committee norms for banking. Meaning, the Basel Committee on Banking Supervision formulates international standards to strengthen regulation, supervision, and risk management in banks. The Basel Committee on Banking Supervision, established by the central bank governors of the G10 countries in 1974. Keep in your mind that when it is formed in 1974, Basel Committee by the G10 countries, that is Geneva. In Basel, Switzerland is the primary global standard setter for prudential regulations of banks. Its mandate is to strengthen the regulation, supervision, and risk management of the banking sector worldwide. Objective of Basel norms: capital adequacy, ensures bank maintain sufficient capital to cover risk and absorb losses. Risk management: provide guidelines for management of credit market operational and liquidity risk. Financial stability: promote consistency and stability in international banking systems. Global coordination: harmonize banking standards across countries, reducing the chance of regulatory arbitrage. The need to set up this committee was felt in the aftermath of various crises on the foreign exchange markets, and in particular the Herstatt Bank crisis of 1974. Means how the foundation of Basel Committee, because of frauds of Herstatt Bank crisis of 1974. The committee began to formulate broad supervisory standards that it hoped would be embraced by national regulators. Before 1988, regulators across the world looked at the leverage ratio or the ratio of capital to total assets as the key parameter to monitor. But the definition of capital and the ratio chosen varied across the world. This led to the pursuit of a regulatory arbitrage. Bank tried to expand activities in regions with less capital requirements. At the same time, the kinds of transactions undertaken by banks became increasingly sophisticated. Many derivative positions were held off balance sheet and consequently did not need to be backed by capital. It became increasingly clear to the authorities in the developed countries that the system had major lacunae. The period until the mid 1990s was characterized by a rather rigid and standardized regulatory approach. Since the mid 1990s, market discipline and recourse to internal models have been emphasized. Basel II represent an intermediary step. It encourages internal models and self-discipline, but only those banks which meet specified criteria can use internal models. Basel first, 1988, focus on credit risk, minimum capital adequacy ratio CAR equal to 8% and risk weighted assets approach. The supervisory authorities of Belgium, Canada, France, Germany, Italy, Japan, Luxembourg, the Netherlands, Sweden, Switzerland, the UK, and the US came together in Basel to form the Basel Committee on Banking Supervision. They met under the patronage of the Bank for International Settlement, BIS, Bank for International Settlement, means BIS. In 1988, they came up with a framework to set international risk-based standard for capital adequacy. The accord, which came to be popularly known as Basel I, created greater awareness about the risks in banking and encouraged banks to devote more resources to understanding, measuring, and managing risk. The primary objective of Basel I was to promote the safety and soundness of the global financial system and to create a level playing field for internationally active banks. Initially, Basel I covered only credit risk. Basel I prescribed two minimum standards: assets to capital ratio of at most 20 and a Cook ratio of 8%. The Cook ratio was defined as the capital divided by the total of risk-weighted assets. Each balance sheet item was allocated a risk weight. For example, cash and securities issued by OECD governments were given a risk weight of 0. On the other hand, loans to corporation had a risk weight of 100%. Loans to OECD banks and government agencies had a risk weight of 20%. The total capital minimum of 8% of risk-weighted assets had two components. Tier 1 capital consisted of permanent items such as equity. This component had to be at least 4% of risk weightage assets. The Basel capital adequacy norms certainly look small When we consider that in the late 19th century, a typical American British bank held core capital equal to 15 to 25% of its assets. And even in the 1960s, British banks held about 25% of the assets in the forms of low risk liquid government bonds and cash. Going into the subprime crisis, the core capital for some banks was less than 3% of assets. Merrill Lynch would have needed an estimated core capital ratio of 23% before the subprime crisis to avoid going below the 4% minimum level as the crisis began. For UBS, that figure would have been about 17%. Tier 2 capital, also called supplementary capital, included other items such as long-term subordinated debt, that is tier 1 capital or core capital included equity capital or shareholders funds. These included common stock and non-redeemable non-cumulative preference shares and disclosure reserves. This includes share premiums, retained profits, and general reserves. Tier 2 capital includes undisclosed reserves. These were reserves that had passed through the earning statements but remained unpublished. Asset revaluation reserves. These were the result of revaluation of asset like long-term holdings of equity securities. Third, general provisions, loss, loan loss reserves. These were held against future unidentified losses. Hybrid debt capital instruments. They were somewhere between equity and debt. For example, it cumulative preferences shares, subordinated term debt. This needed to have a minimum original maturity of 5 years. Tier 3 capital consisted of short-term subordinated debts with a maturity of at least 2 years. These components could only be used to cover market risk. The amount of tier 3 capital was limited to 2050% of tier 1 capital and supported market risk. Basel II 2004 focus enhanced risk measures and supervisory alignment. Structure three pillars: minimum capital requirement based on credit markets and operational risk. Supervisory review process encourages banks to develop internal risk assessment and CAP capital allocation mechanism. Market discipline transparency requires disclosure of risk exposures, capital structures for public scrutiny. Innovations allowed internal rating based approaches for better risk sensitivity. Pillar 3 market discipline 2010 to 2017. Motivated by the 2007-2009 financial crisis to strengthen banking sector resilience. Its elements are stricter capital requirements, higher quality of capital, common equity tier 1 and increased capital ratios, liquidity standards, liquidity coverage ratio LCR, high quality liquid assets to cover 30-day net cash outflows, net stable funding ratio, and SFR promote medium to long term stability, leverage ratio, curb excessive leverage irrespective of risk weights, counter cycle measures, build capital buffers in economic upturns, implementations, gradual timelines with several jurisdictions like India aligning domestic rules with Basel III norms. Basel IV, informal. Basel IV is not formally a new accord, but set of enhancement to Basel III, mainly refining credit risk and operational risk frameworks, standardizing capital output for more comparability, addressing variability in risk-weighted assets across banks, implementations, and impact. The Basel Committee issues guidelines, not binding laws. Enforcement is via national regulators. Risk in investment banking, meaning investment banking involves risk related to trading, underwriting, advisory, and capital market activities. Risk management in the backbone of investment banking operations, ensuring financial stability, regulatory compliance, and long-term profitability. Investment banks operate in highly dynamic markets where misjudged risk can lead to severe financial losses or systematic crises. Below is the detailed synthesis of risk management in investment banking, integrating domain knowledge, regulatory frameworks, and contemporary technological approaches. Core objective of risk management, that is capital protection, safeguard the bank's assets to maintain operational continuity, regulatory compliance, adhere to Basel III and IV, Dodd-Frank and other local global regulations. Client protection, mitigate the exposure of clients to expected losses. Strategic decision support, enable informed decision making through quantitative and qualitative risk analysis. Profit optimizations, exploit opportunities where risk adjusted returns are favorable via controlled exposures. Major types of risk, that is market risk, credit risk, liquidity risk, operational risk, legal and reputational risks. Risk management techniques in investment banking. Evaluate risk, stress testings, trading limits, hedging strategies, strong internal controls, and compliance and audits. Importance of risk management in banking, that is protect bank capital, improves profitability, ensures regulatory compliance, enhance investors and customers confidence, prevents systematic crises. And thank you. Today's session is over.